Right now, everyone is watching the Middle East. Headlines are screaming. And while the world is distracted by the war in Iran, something else is happening quietly in the background. Something that does not make the front page. Something that has no dramatic explosion or breaking news alert. But something that could matter more to your financial future than anything happening in the Middle East right now. A $3 trillion market is starting to crack. Quietly, invisibly, in a corner of the U.S. financial system that most investors have never heard of. It is called the private credit market, and almost nobody is paying attention. To understand why that matters, you need to go back to 2008. Before the financial crisis, the system was simple. Companies needed money. They went to banks. Banks lent it to them. Then 2008 happened. The entire banking system nearly collapsed. Regulators responded by forcing banks to tighten their lending standards dramatically. Banks were no longer willing to lend to smaller companies, startups, or highly leveraged businesses unless they had massive assets as collateral. Millions of companies that needed financing had nowhere to go, and that left a gap. And into that gap, a new system was born. To understand how that system works, meet Marcus. Marcus runs a mid-sized software company. He needs $50 million to grow his business. His revenue is good, his customers are loyal, but his balance sheet is not strong enough for a traditional bank loan in the post-2008 regulatory environment. So Marcus goes to a private credit fund. Firms like Blackstone, BlackRock, KKR, and Ares Management stepped in to fill the gap the banks left behind. They raise money from pension funds, insurance companies, and institutional investors, and they lend it directly to companies like Marcus. No public market, no regulatory transparency, no mark-to-market pricing, just a private deal between a lender and a borrower. At its peak, the private credit market grew from roughly $350 billion in 2008 to approximately $3 trillion today, a tenfold increase in less than 2 decades. It now rivals the entire U.S. corporate bond market in size, and almost none of it is visible to the public. Now here's where the problem starts. Most private credit loans are floating rate. That means when interest rates rise, the borrower's monthly payment rises automatically, and Marcus's loan is no different. He borrowed at a rate that moves with the market, and rates have been elevated for longer than anyone expected due to the Middle East crisis. Oil prices have surged. Inflation has stayed stubbornly high. The Federal Reserve held rates steady at its most recent meeting, refusing to cut despite a slowing economy because of the oil crisis. That means Marcus's interest payments keep rising. His cash flow is shrinking, and he is running out of options, and Marcus is not alone in this trap. The U.S. government is currently carrying approximately $38 trillion in debt. Every dollar of that debt carries an interest payment, and those interest payments are now the single largest line item in the federal budget, exceeding defense spending for the first time in history. The government itself is caught in the same trap as private credit borrowers. It borrowed cheap. Now it is refinancing expensive. It has to issue new debt to pay off old debt, which means the Treasury needs buyers. Which brings us back to Japan and the yield curve and everything we have already shown you. The pressure is building from every direction simultaneously, and Marcus is caught right in the middle of it. Now, before we get into what happens next, we have been tracking these signals across multiple videos. If you want to stay ahead of what is coming, the link to the playlist is in the description below. So, what does Marcus do when he cannot make his full interest payment? In a public market, a missed payment is a default. It is reported, it is visible. Investors can see it and react. But in private credit, the rules are different. When Marcus struggles, the fund does not call it a default. Instead, they use something called a PIK toggle, a payment in kind arrangement. Marcus pays his interest not in cash, but in more debt. The unpaid interest gets added to the principal. The loan looks performing on paper while the stress is hidden. Private credit is very good at hiding its problems. Unlike public markets where every default is visible, private funds value their own loans internally. They decide what those loans are worth, and they have every incentive to keep the numbers looking clean. This is not a small problem. According to research from Lincoln International, the shadow default rate in private credit has more than doubled since 2021, from 2.5% to 6.4%. And Morgan Stanley has warned default rates could reach 8%. Swiss banking giant UBS puts the worst case even higher, at 15%. And the people closest to this market are saying the same thing in plain language. Jamie Dimon, CEO of JP Morgan, put it plainly, Bad loans are like cockroaches. Where there is one, there are usually more, and the cockroaches are multiplying. If you want to know where the biggest concentration of cockroaches is right now, it is in the software sector. Software companies represent approximately 40% of all private credit loans. These are exactly the companies being disrupted most aggressively by artificial intelligence right now. The AI bubble is eroding their revenue models, compressing their margins, and in many cases making their entire product obsolete. Companies that borrowed heavily to grow are now watching their cash flows disappear, and the debt payments are not disappearing with them. The cash flow is gone, the debt remains, and the private credit funds holding those loans are quietly marking them as performing. But here is the thing about hidden problems. They do not stay hidden forever, because while the funds are marking these loans as performing on paper, the investors who own shares in these same companies are looking at the same borrowers and reaching a very different conclusion. The market is already pricing in this stress. Shares of private credit firms have been in free fall in the past weeks. Ares management fell over 12% in a matter of weeks. Blue Owl Capital has lost over 8%. KKR has declined almost 10%. In essence, the companies running these funds are telling you something is wrong through their own falling share prices. Now, here is what makes this visible to ordinary investors. Pension funds have been searching for yield for years. With traditional bonds paying low returns, pension managers turned to private credit for higher income. They invested, and when they did, they agreed to lock their money up for years, sometimes a decade or more. That was the deal. Higher returns in exchange for giving up access to their capital. But now those pension managers are discovering that even the limited access they were promised is being taken away. These investors were promised periodic redemption windows, quarterly or monthly access to their capital. The funds made it sound almost as liquid as a bank account, but the underlying loans are illiquid. They cannot be sold quickly. They cannot be marked to market. And when investors tried to get their money back, they discovered the truth. The money was not as accessible as they were told. BlackRock has limited investor withdrawals in the past few weeks. Blue Owl Capital blocked redemptions entirely in February. Blackstone faced enormous withdrawal pressure. Morgan Stanley's private credit fund met only 45.8% of redemption requests in March 2026. Think about that. An investor who put their money into a fund that promised quarterly access tried to withdraw and was told no. And it is not just institutional investors being exposed to this risk. Most ordinary people do not choose to invest in private credit. They are guided there by financial advisors who earn upfront commissions as high as 3% for recommending these products, plus annual fees on top of that. In essence, the people whose retirement savings are flowing into these funds are often not making that choice independently. They are being steered there by advisors with a direct financial incentive to do so. And now there are proposals to allow 401k retirement accounts to invest directly in private credit, meaning the retirement savings of millions of ordinary Americans could soon be exposed to this market, often without fully understanding the risks they are taking on. And the stress does not stop at the institutional level. It travels. If retail investors stop pulling capital into these funds, fund managers stop deploying new loans, which means companies like Marcus cannot refinance their existing debt, which accelerates the defaults, which spreads the stress further. Currently, new fund launches in private credit are already declining. The institutional money that fueled a decade of growth is pulling back before the problems become fully public. That is not a coincidence. JP Morgan recently restricted its lending to certain private credit companies after discovering massive valuation gaps in their loan portfolios. And when the largest bank in America starts pulling back from private credit, that is not a routine business decision. That is a signal. Banks have approximately $300 billion of exposure to private credit funds through credit lines, financing facilities, and funding structures. If private credit stress escalates, it does not stay in private credit. It spreads. Less exposure is not the same as no exposure, and there is one more pressure point making all of this worse. The job market is dropping. Businesses facing rising costs and slowing revenue are cutting headcount. Rising unemployment means fewer consumers spending money. Fewer consumers spending means lower corporate revenues. Lower corporate revenues mean companies like Marcus have even less cash flow to service their private credit loans. The chain from oil prices to inflation, to Fed paralysis, to private credit stress, to job losses, to consumer spending, collapse to loan defaults is not theoretical. It is happening right now in sequence, and it does not exist in isolation, because private credit is not the only system under pressure right now. It is simply where all the other pressures have been accumulating. The yield curve inverted, the bond market warning that a recession was approaching, Japan pulling back from U.S. treasuries, keeping long-term yields elevated, removing the Federal Reserve's flexibility and tightening financial conditions across the entire economy. Oil surging, adding an inflation shock that has frozen the Fed and deepened the economic slowdown. And now private credit, a $3 trillion shadow banking system, sitting at the intersection of all three pressures simultaneously. Floating rate loans becoming unserviceable, hidden defaults accumulating, withdrawal gates closing, banks exposed through $300 billion of connections. And while all these happen, the institutions that watch these signals most closely are starting to say something out loud that most people are not ready to hear. Goldman Sachs, the bank whose forecasts move markets, has raised its U.S. recession probability to 30%. That is not a fringe prediction. That is one of the most respected financial institutions in the world, quietly telling its clients to prepare for the possibility that this cycle turns. These are not four separate stories. They are four forces pushing the same system toward the same breaking point. We are not in a financial crisis. The signals are early. This is not 2008. The banks are now better capitalized. The system has more buffers. But like we said earlier, less exposure is not the same as no exposure. Modern capitalism has a predictable pattern. Invest in the financial instrument that pays the highest return. Ignore the risks. Attempt to cash out at the peak, and hope that someone else is left holding the bag. Right now, a very large number of investors are discovering they may be the ones holding the bag. The question is not whether private credit will survive this cycle. The question is whether the people whose retirement savings are locked inside these funds will find out in time. Because private credit is a system that has grown too big to fail quietly, without most people ever noticing it was even there. But when several of the world's largest financial institutions start blocking withdrawals simultaneously, that is not a routine operational adjustment. That is a signal. There is one more force quietly removing the foundation that all of these loan repayments depend on. Something happening in offices and call centers and software companies across America right now. Silent, fast, and directly connected to everything we just discussed. That is the next video. We track the signals that move before the headlines do. If you want to see them before everyone else does, hit the subscribe button now. And if this video was helpful, share it with your friends. Thank you.